Welcome to MasterTrader.com, where you learn simple market analysis to make money investing and trading in the markets. I'm Dan Gibby, Chief Option Strategist, and in this week's Chart of the Week, I'm going to show you how we're going to sell two different options to create a synthetic long bullish position. The chart we're going to look at is the gold mining ETF, which is GDX. This is a daily chart, and it came down very hard for many days, and it approached this prior low from December. Beautiful, huge bottoming tail. Now, remember that at the low of the day, this was a big, ugly red bar. But at the end of the day, it closed at its dead high, and it's actually a green bar. So it closed above its open. That is very bullish. So we have major support and bullish bottoming tail. At MasterTrader, everything starts with a bias on the chart, and then we just match the proper option strategy to mirror that expectation. Now, it's just a swing trade to us since it's extended climactic, so we just want a short-term bullish option trade or stock to profit from the retracement back up. In our MasterTrader Option Strategies series for investors and active traders, we teach all of these strategies. It's a fantastic 10-module in-depth course, and we divide everything into these two categories. Directional option strategies, when we are wanting a big target with multiple time frames in alignment. Income strategies is when we're selling options around turning points on the charts to profit just from calling a short-term top or bottom. I'm going to review a few possible short-term bullish stock and option strategies with you here. First, it's a swing trade for a bounce. You can just buy the stock if you want. You have unlimited profitability, but it's going to take a lot of money, 50% of margin. So that's going to cost you over $10,000. So that's going to cost you over $10,500 if you buy 1,000 shares of this GDX. And also, when you buy stock, you have a huge maximum loss. Sure, we use stop losses, but potentially your entire investment is at risk. A covered call is buying stock plus selling a call, so that lowers your cost basis and the cost of putting on the trade, but the downside is you're capping your profitability by selling that out of the money call. You still have the 50% margin problem as you do here because you're still long stock and the maximum loss problem. A bull call vertical spread is when we buy an in-the-money call for the directional bias, and then we're still selling an out-of-the-money call, similar to the covered call, but we have a lower cost basis to put this trade on. We're still capping our profitability. When you buy options, time decay is a drag on your position, so the stock has to move for you to be profitable, or else you actually have a small loss on your hands. The debit, so the total cost of putting this on, which is significantly less than a covered call or long stock, is your maximum loss. So that's a definite benefit over these two positions. Let's go to the next possibility. We can short out of the money puts, where we think the GDX will expire worthless at expiration. Whenever you sell options, your maximum gain is the credit received. One benefit of the margin here is it's only 20% of the strike price as opposed to 50%. Your max loss is pretty much the same as a covered call here because short put is a synthetic equivalent of a covered call. Now that brings us to our synthetic long position. This has, so what we're going to do here is sell an out-of-the-money put, 21.5, and we're going to take that money and buy a call option with it. So the stock was trading right here, 21.68, so that's why we selected the out-of-the-money 21.5 puts and then buying the out-of-the-money $22 calls. It's only an 8-day trade, 8 days to expiration, because we're just trading this for a bounce. And putting in this as one order, of course, we're taking in 5 cents a share credit. So other than the capital requirement, we're putting money in our pocket for this trade. Let's look at the risk to reward on this. So we have unlimited profitability, similar to long stock. So the only capital required on this position is being short the 21.5 put. The max loss is the short strike, 21.5, less the 5 cents you put in your pocket. So that's 21.45 cents a share. But you can now see that we're putting on this position similar to long stock, and it didn't cost us anything other than the capital requirement. Here's what happened 3 trading days later. We closed it at $1.03 a share. So here's my order logged up. We're just closing this, so we're selling the calls. That's where all our profit's coming from. And we're closing the 21.5 put at only a penny, so that became worthless. The net credit here is $1.03. If you calculate the return on your capital, here's how you do it. We made $1.03 a share divided by the capital requirement from your broker, and it's just roughly 20% of this short 21.5 strike, and that gives us a whopping 24% return in 4 days for our synthetic long position, which we created by selling 2 different options. Our Master Trader Weekly Options Trader is a phenomenal service for those of you interested in making money selling short-term options around the charts like we do. We're experts at this. In fact, we just booked 30 consecutive wins in a row in this service. They're great opportunities for gaps, earnings, failed patterns, volatility trades, just calling short-term tops and bottom in the indices, ETFs. We have a defined portfolio that we monitor every single day looking for these opportunities. So check it out. It's only $39 a month. As always, feel free to leave any questions in the comment section below. And don't forget to subscribe to the channel if you want to continue to make money investing and trading in the markets. That's all for now. Happy trading, and see you next time.